Okay, everybody, we're going to go ahead and get started. We'll start off with some levels, some dates to monitor, as well as take a look at some macro developments that are lining up, in my opinion, for some kind of a meaningful reversal. So we're just going to analyze the actual correction, the bear market that we're in, and we'll get into the larger structure, whether it's an uptrend or it's going to be part of a bigger bear market. We'll get into that once it's confirmed. But for now, we're going to start off with just analyzing the bear market. And a bear market is a correction. It's a correction on a very large degree, but it's the same kind of patterns that we see on 5-minute charts and 1-hour charts. Just it's happening on a lot larger scale. And so we're looking for these similar patterns that we see. And so far we have that. So I'm just going to go over this. Corrections unfold in 3 patterns, 3 waves, right? So your A wave down, your B wave up in a correction, and then your final C wave down. And you're looking for a few markers to kind of help you gauge when you're getting close to an end. One of them is you want to see a symmetrical move. So what I'm doing here is I'm measuring the length of this final leg down, the C wave, in proportion to the A wave. And this 100% right here at 3953 at this price point was whenever the C wave was 100% the length of the A wave. And we tend to see these corrective patterns, they tend to end around this level. And you can see the market was really battling around there, but it went lower. And we found a pretty significant bottom at the 150% extension. So this C wave is exactly 150% the length of the A wave. So we have that symmetry in place. The other thing that I'm looking for is the final C wave is always going to be a 5-wave pattern. And we have that. You can see this very clearly. 1, 2, 3, 4, 5. We have 5 waves down. Now, what I'm suggesting is that we're not completely out of the woods yet. There still is a chance that we make one more low lower, and I'm going to go over the evidence for that. And maybe not a lower low, but maybe just like just a nominal low, which would kind of constitute a double bottom. But I still see that as a threat. And I'm going to go over some of the reasons why that is. For one, we seem to be trending in what looks like a very large termination wedge. And that's basically just when price trends within this sloping triangle. And then it eventually just pops out and goes. And once we break out above this level right here, that would be a good sign that, you know, there is some kind of a meaningful trend change underway. And as you can see, even with the action today, we haven't broken above that level. The other thing is, one of the patterns that I'm looking for is and this is pretty constant. This is a pretty constant pattern when it rarely does it play out, is the final leg down is a 5-wave pattern. That third wave right here is usually the most dramatic moment of the correction. And it's met with the most momentum and also the most volume. And as you can see, this third wave down right here, we did get peak momentum right here. And as price made a new low right here, it did so on less momentum. And we also got a pretty heightened volume rush right here. However, look at what happened on this move right here. To me, this was the most dramatic move of the bear market. I mean, this was just, 3 gaps down in a row. I mean, just basically vertical. And it happened on pretty heightened volume right here. You typically don't see corrections in bear markets end on these dramatic moves right here. They tend to have a dramatic move and then one more menial low on lower volume and lower momentum. And so this right here, just based off probabilities, is telling me this is probably not the low of this bear market, that we would have some kind of attempt to make a new low, maybe a double bottom, maybe down into the 35.80 range. The other momentum indicator that I use, I call this my trend finder. And this is basically the 1-day trend finder. Every time it rolls over from overbought levels up here, it tends to mark a new leg down. As you can see, it's pretty consistent right here. Happened here again, and it just happened. Now we are getting a little bit, instead of just a drop, it's starting to level off. So if it levels off and turns back up, that's a really good sign. I imagine price would further confirm that. So just the technicals, the structure of this is telling me just to be a little bit cautious right now. We're keeping our hedge on. I bet we're going to have some weakness going into next week, which we'll look to reduce our hedge and probably get start buying a little bit more close to wherever it looks like we're getting some kind of a bottom. More warning signs I wanted to talk about were semiconductors. semis have actually been leading us this entire time. If you take a look, this is the S&P 500 in blue. The red is SMH. It's an ETF tracking the semiconductor sector. And if you take a look here, semis topped in December 27, and the S&P topped in January 4th, right? So semis topped first. And look at this moment right here. This was the B wave before the C wave down. You can see semis put in a nice head and shoulder pattern that was confirmed on April 5th. The S&P didn't confirm that it's dropping until, when was that? What is it? April 21st. So actually, no, I'm sorry, right here, April, what is that? April 8th, April 11th. So a few days before. So it led this drop down. Then look at this right here. Semis bottomed on May 12th. The S&P bottomed on May 20th. So semis bottomed first on this push forward. And we had a similar situation where semis broke down one day before the S&P 500. So far, it's been leading almost every move in this bear market. And look at this. Semis made a new low. They made a new low on July 1st, and the S&P 500 has not made that new low. So either this correlation has broken, which would be a strange thing to see at a bottom. That would have other implications if this were true, which we would talk about in future webinars. But more than likely, semis are signaling that there's some more weakness to come for the broad market. So this is giving me a little bit of a warning, as well as the technical stuff I talked about. And the other thing I want to talk about was Apple. Now, Apple's been leading this charge, especially in tech and with the FANGs. And this is the structure of the move higher. And look, it's a very clear three-wave pattern. It's very symmetrical too. This is 100% extension. And you see price is really struggling right at this level right here. And if we look at the third leg up, the C wave, it's a clear 5-wave pattern, 1, 2, 3, 4, 5. So it's a complete 3-wave pattern up. And so at minimum, I would expect some kind of a drawdown into next week. If we hold, the low and then turn back up, that's a really good sign. But all these signs that I just talked about are telling me just to be a little bit cautious right now. The main thing is this, and y'all have heard me talk about this a lot, and I'm going to talk about it again. We are approaching probably the most important cycle of the year, which is July 20th through August 3rd. And I'm going to go over this. I do a lot of cycle analysis. It tends to be eerily accurate too. And so this is probably the most important cycle that's been present in the broad market since 2018. And you can see it's 100% accurate. And this is a very tight window. We're talking about maybe 6 days, 6 trading days right here. So we're not talking about a big window. We're talking about a very narrow window. It caught this swing high in 2018. It caught the 2018 high. It caught the COVID high. It caught the September 2020 high, and it caught the bear market high, or the bull market high, leading to this bear market. And it's showing up again starting July 20th. And this cycle alone is enough to be cautious, to see what's going to happen going into it. But we have more. We have our square of dates, which have been pretty significant in tracking the cycle beat, if you will, the beat of the dips and the swings within this market. Is coming up again on July 30th. And we also have the 40-year cycle from the August 3rd, 1982 low coming up on August 3rd. And so we have all of these major inflection points, all pointing to a very tight window starting next week on July 20th. And so what I would love to see is a breakdown and say we do a double bottom into this window right here. Maybe one lower low on weaker volume and weaker momentum. We would take our hedge off for a nice little gain, aggressively buy. The other thing I would be willing to accept is maybe a breakout and we trend sideways, and then we get a gap and a go. That would be also very acceptable. What I don't want to see happen is us have strong strength next week and into the following week, where we probably top somewhere around 41 to 4,300. That would signal that we're just in a bear market rally and we have lower lows to go. So this is a very important inflection point. We have all these signs right now telling us just to be a little bit cautious going into next week. So I want to see what's going to happen going into next week. And so if we go into some of the macro pictures, I've talked a lot about this. The two things that matter the most right now to equities, especially risk assets, are going to be rates and the US dollar. And what we're tracking here is TLT. It's an ETF by iShares that tracks the treasuries that have a duration of 20 years or more, so long duration treasuries. And as you can see, a very symmetrical, a very clear corrective pattern from the COVID low, basically that marked the top in bonds and the low in rates, because there's an inverse correlation with rates and bonds. So as bonds go down, rates go up, putting more pressure on risk assets and equities. And so we have a very clear 3-wave pattern, and look how symmetrical this is. This is the 100% extension. So what I'm showing you here is that this C wave down bottomed at the exact level that made it identical to the drop in the A wave. And that's the kind of symmetry that you want to see. However, if we analyze the structure, it just looks like we have only 3 or 4 waves down. So 1, 2, 3, 4, 5. I'm expecting one more drop, probably down to this 101 level, maybe a little bit higher. But it looks to me like this is a corrective bounce forward, and that we're setting up for one more drop to finish off this this really intense bear market with bonds. And what that means is that when we get that lower low, it's setting up for a multi-month rally in bonds, which would be a multi-month downtrend in rates. So that lines up as well with what we're seeing with an equity bottom happening, or some kind of an equity bottom. Furthermore, one reason I'm cautious is if we look at the RSI, we have very clear bear market resistance right here at the 49.50 level. As you can see, the second wave got stuffed right there, which was right at the 49 level, and we're right at that level again. We're still below it. So if we were breaking out above it, then that would be a really strong sign of strength. But so far, we're not doing that. So what I would like to see to confirm that a low is in is if we trend higher above this 121 level, and we see the RSI take back 49.50. If that happens, it should be lining up with some kind of a low in equities as well. And that would take a lot of pressure off risk assets. The other thing is the US dollar. I mean, it's just been on an absolute tear. And a strong dollar is great, but it also puts a lot of pressure on the global economy, especially emerging markets. We're already starting to see that happening. I mean, we've been seeing it happen, but it's also putting pressure on the equity market in the US. And we need to see this roll over. We do have a full pattern in place, an A, B, C, and we have a 1, 2, 3, 4, 5 wave pattern within that C wave. And we're coming up on very, very strong resistance right here in this blue level. We were expecting a breakout down here, and we were expecting to be kind of the final push in this very large degree uptrend. I did some Gann analysis on DXY, the dollar index. Very interesting stuff for those that have been following me. I do a lot of this analysis. From the 2008 low, if we do a Gann fan, you can see how accurate these fan lines have really been predicting a lot of these moves. I mean, very, very accurate. So this to me is the fan that's really governing this wavy uptrend in the US dollar since the 2008 low. The most important line is the red line. It's a 45-degree line, the 1x1 line. It really defines the bigger trend. And you can see how you've had a lot of activity around this level. And look at this. In 2020, we touched it perfectly, and that marked the top. We're at it again. We touched it perfectly, and we're starting to see some weakness unfold. And we're doing this going into a cluster of cycles in DXY. So we're trending up hard into it, touched a 1x1 line that's been really intact since 2008. To me, if we actually break out above the 1x1 line, test it and go forward, that's not a good sign. But all the signs are pointing to the DXY putting in a pretty meaningful low, which would take more pressure off of equities. So what I'm trying to say is we're very close. I think we're very close to some kind of a meaningful reversal. However, I want to see how we go into next week, and I want to see all the things I talked about start lining up. So that's kind of the bigger picture right there. Now we're going to move into some individual names and kind of show you the positions that we're looking to buy and add to.